So while I assume, Craig?
Yeah, we're good to go.
Okay, yeah, I just wanted to make sure that we're at least still being recorded and that Chris can call in via Zoom.
Those boxes are all checked.
Excellent. All right, thank you. So there will be no call to order. There will be no designation of the minute taker, but maybe some notes when we get to some discussion stuff would be great. There being no people out there in the world, we won't hear from any of them at the moment. So we do not need to approve the agenda, nor do we approve the minutes. I guess a report on the Doe Farm and Land Stewardship Subcommittee would be appropriate. So in January, I gave a presentation on the Doe Farm Management Plan. It was a repeat of the one that I had given to the Lamprey River Advisory Committee. There being fewer time constraints on the Land Stewardship Committee than on the Advisory Committee, there were more questions and a bit more discussion. But all in all, everyone seemed pretty pleased with that. It is now accessible as a PDF on the Doe Farm website, which I think is actually maintained by the Conservation Commission, at least for us. And I'll be drafting a thing for the Friday updates that lets people in the town know that the management plan is all 90 pages of it. And I got permission from Charlie Marino to use a photograph in the Friday update. So we're square with that. In addition, we have received from the Tree Farm Committee a certification of our status as a registered tree farm, certified tree farm.
Excellent.
For the next 5 years. So one of our goals for 2026 is checked off. Land Stewardship Subcommittee, obviously, they discussed that stuff, and we had further discussions about the various properties. Still working on signage and trying to get that consistent. Other than that, things were pretty peaceful and quiet. So that's all I have from the Land Stewardship Committee this morning. Area is quiet.
I'm not going to be able to burn much time on the clock with this report. No, there is nothing going on at the cemetery. There have been no sales, no inquiries about sales, and obviously no burials. And there won't even be much of anything out there after the storm because it isn't plowed. So it is definitely closed.
It is definitely closed. All right. And we typically don't have a cemetery committee meeting until spring when things thaw out and you have a chance to take a peek at what might need to be done.
Yeah, usually what I do is when the snow melts sometime in February or March, I'll go out there, I'll take a walk, and I'll have a meeting with our friends at the DPW and talk about sort of what needs to be done. You know, things like putting down a couple of wheelbarrow loads of gravel to patch the potholes isn't something that requires a vote, but I'll plan out what needs to be done for the year, and then I'll convene a meeting of the cemetery committee to talk about anything that requires the expenditure of some budget or, you know, others the committee's approval. So I'll probably start that process next month. We'll see how much
snow.
So much of what we do is weather dependent, but I'd anticipate this coming year we are going to have some expenditures. There's a couple of things kind of in the back of my mind. One is we've got to get we got to do something about that wall that's starting to crumble. I've had those discussions with them, and that's not going to be an easy process. We don't have anybody just sort of lined up to do it. So I have to talk about that. And the other is probably ought to survey out another section of cremains plots and do the work to have those laid out and the foundations poured, because the ones we did 5 or so years ago are nearly all sold. So that's what I anticipate doing, but that's only a very rough outline.
Okay. Well, popular place, people are just dying to get in.
Yes, they are.
To use a very old joke. I did think of something on the Land Stewardship Subcommittee. Sometime in March, there will be a discussion about herbicide applications, prompted by
Excuse me, I missed that. Application for what?
herbicides.
Herbicide, yeah.
Prompted by concerns by folks down on the Mathis Cove area
Yeah.
and the town's treatment of knotweed. And so there'll be an open meeting and stuff like that. So more on that later. With this month, but I believe the state's expert on toxicology related to herbicide application was not available until later, almost into the spring. So we'll participate in that. I guess with the treatment of the knotweed down there, they're practically in people's front yards. Excuse me. They're all on wells, and there are some questions about the longevity of the stuff and half-life and so on and so forth. The details of which will get discussed at that particular meeting. So I don't think at this point it has any particularly direct impact on how we handle herbicide treatments on the Doe farm, which is where it comes into play for most of us. Is there any use of herbicides at the cemetery? That's a question.
Not that I'm aware of. It's not a forested plot.
Right.
It's not a forested plot.
Right.
There's the slight buffer. There's the slight buffer around the edge. Around the edge. Between development that has some trees in it.
Right.
But a casual look by a non-expert, that would be me, thing like the problems we have out at Doe Farm with invasive species. Nor are we managing it for anything other than shade and separation from capstones. So
Right.
it's a little bit different situation. So I'm not aware of any herbicides out there. I can check with the DPW.
Might be useful at some point to know that. There is a conservation easement out there somewhere, right? Because I know we paid a bill recently.
Yes, there's an easement, and we just paid, at the last meeting, we paid $360 for the monitoring of it.
Right.
I'll have to go look up exactly what the easement is.
Yeah, so is it whether the easement requires our abutting landowner to maintain the property in a natural condition or whatever it is. But the larger question, the herbicide question comes up because of invasive plant species. So I'm not sure what our situation is out there in the easement, and if that were a place where invasive plant species, we may own the easement on their property, which probably does not give us the right to treat any invasive species. I don't know. Something to think about is what's the role of the invasive species and the easement, and
Yeah, I'll take a look at that in advance of our next
Right.
meeting.
We could engage Veronique Ludington, the stewardship coordinator. She might be able to, if not shed some light on what the easement's all about, but she may be able to help us figure out whether there's anything that we have to worry about relative to invasive species. I can recognize a lot of them, but I don't recognize all of them. Anyway, food for thought. Let's see, so that takes care of notes on those items. I have heard from Deb Ahlstrom that there are no expenditure requests for us to think about.
Okay.
And because we are not voting on anything today, we don't have to get our heads around the MS9 spreadsheet. Other issues and things of concern to the trustees in general?
None from me.
Yeah, none for me either.
Okay. I can report that I have filed for re-election.
I noticed that.
Jennifer McConaughey.
And whether that's a good thing or not, I'll figure out later. But yeah, might as well, now that I'm starting to figure out where most things are and how it all works. And I suppose I'll be willing to continue as chair unless Alberto has a desperate need. We'll figure this all out in March at our
I'm
first.
happy for you to continue.
And happily, I think we have things divvied up reasonably well, so it functions. So. All there. So our investment folks will be in a few minutes. I did have a brief conversation with Chris yesterday when he called and said, "Oh, there's disease and pestilence at my house." Oh,
Yeah.
Okay. We don't need to bring that disease and pestilence among us. Thank you. Appreciate that. So he will be calling in. I suppose, even though it's not official, I should probably stay close to the microphone for Craig. But I did reiterate some of the questions that we had relative to the insurance clause that James was questioning,
Yeah.
relative to the duration question. Also, how trust is structured inside of Eastern Bank and who gets blamed for what. Yeah, that was that part. Yeah, and then and how that ties back to the audit question, which is what James's originally triggered his concerns of, this doesn't talk very much about Cambridge Trust here, what's the story? But that was a 2024 audit, which was right on the heels of the merger. So, not surprising it didn't answer all the questions. So I think that was it. Oh, and the ES&G question. Boy. we laid out a bunch of stuff and he shared a couple of things with me, which I will probably let him share again here, directly to us. So he was indicated that Cambridge Trust, both he and Lisa, more than happy to help us understand how things work and provide some input in terms of how we might adjust the language of our investment policy to recognize exactly how things. So that's sort of where we are. So we've got 10 minutes. We'll put a pause in this. Hang out until they show up.
You want to take a recess for 10 minutes until he arrives?
Yeah, that sounds like a good time.
Okay,
Yeah.
I will let you know when he arrives and we can come back in.
Perfect.
Thank you.
Great. Thank you. How was the Philippines?
Yeah, exactly.
subchapter Ks or what bankruptcy proceedings or anything that came along with that,
Yeah.
et cetera, et cetera.
Because,
Yep, that's
because
exactly right.
to that point, Ted, we could switch custodians at any time. We could say, we're not getting the service we think is necessary to Fidelity, or any number of custodians for whether it's a fee purpose or so to that point, they go out of business, we just move custodian, and it's a very simple process because again, SEI has no control over these assets, and that's the biggest difference, the control aspect. There is zero control. They take directions from us on intaking these assets, and if we need to move them, then the same thing would happen there.
Okay. That's all very helpful. Thanks to both of you on that. I think that covers that piece. Any questions from Alberto, Tom?
Nope, no.
Make it
That's
nice
That's
and
it.
clear.
That's a perfectly clear explanation, and thank you.
Excellent. Yeah.
The other couple of pieces, I should have written this down, I hope my memory. One had to do with.
Yeah. I
there's a-
actually have your email right
Oh,
here.
thank
Do you
you.
want to?
No,
Okay.
I can, you can remind me if I don't
I
get it.
sure will.
Wanted to do, there's a statement in our investment policy about the trustees voting on the duration for the fixed income securities. And to my knowledge, all the time that I've been here, we've not done that, so it's partly our problem. But in our conversation that Chris had yesterday, it was, maybe what needs to happen is an adjustment to that language that, and correct me if I don't get this right, Chris, there is a benchmark, and if we're within a percentage point of that benchmark, up or down, we're kind of in the ballpark of where we need to be, and that provides you all with guidance without the trustees every quarter having to approve, well, we're going to have a duration of 24.5 or whatever the number happens to be at that time, but rather it's bound within some percentage, some standard deviation of a benchmark. Have I captured that about right?
It's perfect, Ted. We've done this with other institutions, other towns. We want a little bit more clarity, a little bit more, risk control on the duration of the fixed income assets. Right now, and it's in current policy, the town's fixed income component is being benched off of the intermediate gov credit, and that has approximately 4 years, average maturity length. There's other components of that, but that's what we'll use. You could do, okay, if it's around 4, how about we make our range for duration stay between 3 and 5 years. That gives us the capability to dial up duration when we think it's appropriate, or dial it down, when we want to get a little more conservative with interest rate outlook. Another approach would be, because the duration of the index will change over time. It takes the form of the underlying asset class, and so that can slightly drift lower, can slightly drift higher. You could also do something where it's plus or minus 25% of the duration of the intermediate gov credit. So if it's around 4, that's around a year. And so say the benchmark were to float a little higher to 4.25, then that allows us a little bit more wiggle room going north of that. So either way provides us with clarity, provides you with clarity that and expect when we report on a quarterly basis. Here's our duration, here's the benchmark. Are we within that range? Yes, okay, great. We've done our due diligence here.
Right. And what was that benchmark specifically?
Yeah, it's called the Bloomberg Intermediate U.S. Gov Credit. And you'll see it on page 5 of the report. And it is in the IPS already as your fixed benchmark. So
Yeah, I see it there. Bloomberg Intermediate U.S. Government Credit. Okay. And so that's already part of our performance benchmark. And so we're now also using that same what we're suggesting here in our conversation is that we're going to use this benchmark as a governing mechanism on the duration. And in effect, avoid having to vote every quarterly meeting as long as you are operating inside of this. You'll report that duration to us as you've been doing. We'll just be able to nod our heads and say, yes, it's within the framework. And then at some point, through your advice, if we're hearing, gee, it needs to be a little
Longer or
higher.
shorter, sure.
We want to hold them a little longer, we want to hold them a little shorter than the benchmark suggests, then we revisit that. Does that make sense?
perfect sense. And, you know, I think that 25, whichever way, you know, the trustees choose, gives me enough latitude to, you know, dial up duration, slightly dial it down. We're not trying to make huge, you know, bets on duration. Interest rates have, you know, kind of been all over the place, as we all know, over the past couple of years. With that being said, I think the trustees probably remember we have been adding to duration over the past few years, and that has been a good thing, as interest rates have gone up. And now, you know, if you're on that page 5, you can see, you know, that has paid off with an almost 7% return. So, you know, we're not taking undue risk here. 4 years is still a very short average duration for the portfolio. This is just basically saying, hey, we like 4 as our target. You have a little bit of wiggle room to deploy your best thinking, and we'll confirm it on a quarterly basis.
Okay. So it'll be up to ourselves whether we have an absolute limit or we have a relative limit in terms of like a percentage of the benchmark.
Either one will work for us.
Okay. Tom, questions?
That also makes sense to me.
Okay.
We'll have to
Sounds
revisit
good to
that at our next meeting when we can actually vote on things.
Yeah, exactly. Yeah, I don't know if I mentioned to Chris, to include the town in our mailing out of the agenda, so we're not in an official meeting at this point, although it's taking notes furiously. And we are recorded, so we all can go back and visit with that. The other question that came up, and we've discussed this a little bit among our group, had to do with the ES&G. Our policy says slightly above average, which I guess puts us a little above a 3 in the Morningstar system. And our discussion before was we probably would like to stick with that. We certainly probably won't be decreasing number. You know, we'll accept the Morningstar 1.5. No, we're not going that way. But we're probably not going to, you know, to a pure ES&G, give us a 5.0. I think the discussion with the trustees who put this in originally were all good folks and had good conversations with probably Peoples back then, not Cambridge Trust, but whenever it was put together, I think they got good guidance on how that operates. And so I guess, are we still in good shape using this Morningstar ES&G to help guide us a little bit? And how should we go about I guess, ourselves relative to that ES&G number. It strikes me as, you know, maybe a nice annual exercise, not something you want to be doing every quarter. I don't know how dynamic the rating system is, and, you know, do companies get rated every year, or, you know, how static is that index? And we're using Morningstar, and I know there are several more kinds of things out there. I don't have any basis to decide whether one's, so why don't you help us out, understand this ES&G stuff a little bit, Lisa?
All right. Actually, I'm going to turn it over to Chris. Although I would say that ESG always factors in at least a certain amount into our investment decisions. And again, I'll turn it over to Chris.
Yeah, I think that's a good point, Lisa, just in terms of, you know, the sustainable nature of a business. You know, we're long-term investors, so, you know, we're not going to, you know, chase certain things, and certainly things that, you know, may be detrimental for an industry, a sector, the environment over the short term for, you know, short gains. So, you know, taking a step back here to kind of give the full context, and I discussed this with Ted yesterday, what we attempted to do maybe 5-6 years ago was to start to move the portfolios towards a higher Morningstar average rating across the equity portfolios. With that being said, it was relatively easy. It was all manual, but the portfolios previously for the equity allocations were all funds and ETFs. And so if you go on Morningstar, you could pull up each fund, you can get their sustainability rating, kind of do an aggregate, market cap weight, and then you know, do an average, kind of see where you are now, and then kind of set, you know, a goal on an annual basis to you know, increase that. What that means is, you know, swapping out traditional funds or ETFs and starting to move into ESG funds. So whether that's in the large cap, mid cap, small cap, and then international, of course. Since moving to Cambridge Trust, this was kind of put on the back burner as we moved into an individual stock strategy for the large cap component. Obviously, that is the equity income strategy that we've talked a lot about, more of that value tilt. Instead of, you know, going through 60 names and getting that average and doing it that way, the trustee said, let's just stick with ESG national component of the portfolio, and that way we'll get, you know, to you know, a higher sustainable rating. So again, nothing scientific, but that was the thought process. It put that in perspective. International is about 20% of the equity allocation right now. Going forward, would love to tighten this up to have it make a little bit more sense, especially now that we're, you know, utilizing individual stocks for a little over 75% of the portfolio. A couple different things you can do here. I think it is a good idea to kind of evaluate this on an annual basis if you are looking at it from an evaluative perspective. Another thing you could do is, you know, change the language to say, outside of individual stocks, anytime we use an ETF or a mutual fund, you know, we're gonna rely on you know, sustainable funds. You know, there's a number of different things you could do there. Obviously, and I mentioned this, Ted, I'll mention this to, you know, to you guys as well. Cambridge does have an ESG, always something we can look at. As a long-term track record, Cambridge was one of the earlier investment firms to start a strategy there. But I'll caution, you know, and there has been a movement away from this for various reasons, but one has been, you know, performance has been tough, excluding certain industries and certain companies, and you know, slippery slope when you start going down to where we want to invest in, where we don't want to invest in. And so what we have found, I think this is the part of the decision that the other trustees kind of came to, is let's stick with, you know, your best thinking over here. And to Lisa's point, we're always have a framework of ESG in mind, but let's utilize ESG funds for the rest of the portfolio, and that's kind of where we are today. So we're open to anything and everything that the trustees would like us to do. You know, we have a lot of different capabilities that we can to bring to bear here. It's just more about, where you all want this to go, and we can, figure out a plan.
All right. So as I understand this now, whatever ES things we're doing are done essentially in mutual funds where the individual equity is not identified. And it's a pretty simple to do that because Morningstar rates those things. If you're going to go then apply those same standards into the companies, now it's a bit more mathematics and a bit more stuff that you have to chase down.
For changing as well.
Now you
because
need a number for every one of those
Individual
companies.
company. Exactly. Yep.
Right. And, here's where, I don't know how often those kinds of audits are done. So that if company A gets an ESG number 2 this year, what is that relative to what it was before, and when was that previous one done? I'm guessing, having been involved in certification of forest management and chains of custody and things like that, I know it's not done annually. And so there's always a lag of when these guys are, it's not cheap.
No.
And so getting those, nobody wants to spend that kind of money every year just to get a number. And so there is a question of, how current is the information? And then as I understand it, these ES and G numbers aren't really defining black hats and white hats. They're defining, this is a nice company, they do it well. You could be a very bad company, but there's no risk to your investment performance from any of those factors. You're going to get a good rating. It really has to do with the impact on your performance, not the company's impact on the environment or the social system or their governance structure. It's the impact on the company. If they're making lots of money and nobody sees any risk to that, then their Morningstar number would be higher. Am I understanding that right? That's sort of what I read. Although there's maybe some strong correlations between those things, it is possible for somebody to be a complete black hat in those categories, but still get a good, or at least an average ES&G.
Correct, and I think that's, Morningstar and there's other firms that will rank them, and then, it's the active managers that are going to look and say, I think a great example is Meta. So think of Facebook, a very controversial company to some, to many. Some, they're making money, they're doing great things, they're plugged into AI. And I'm talking ESG funds. When you're looking at this, the positive things that we're going to overlook some of the negative. Then you have ESG funds that are saying, absolutely not. We're not going to own Meta for workplace issues and different things that would exclude them according to their own filters. And so, ESG comes in many different flavors. From very prohibitive, where we're not going to own half the S&P 500, to those that say, okay, we need to make sure that we have some exposure to some of these companies, but in aggregate, we're going to be more thoughtful and stay away from some of the companies we really don't want to own. And traditionally, that's energy companies. So I think to that point, it's an ever-changing ranking, and it's an ever-changing rating. If you are on page 9, or if you go to page 9 of the report, you can see some of the funds that we're currently using that are international and ESG, and these are all vetted and approved internally by our manager research group led by Celia Caziu. If you look at the middle of page 9, emerging markets, for example, we have a couple different, we have an active fund We also have an active ETF there. So the first is a DFA, Emerging Markets Sustainability Core, and then you have an iShares ESG Aware MSCI Emerging Markets ETF. So just to give you a flavor, we're already doing this in the portfolio funds to have a little bit more flexibility, and we do the vetting, internally. The reason I wanted to bring you to this page, if you were to give us a mandate and say, all right, we'd like to have all of our non-individual stock equity investments in sustainable/ESG funds, well then we would move out of the top fund, the Federated Large Cap Value, and then the third one there, the Wisdom Tree Mid Cap, and swap those for ESG funds as well. So as you can see, what's the impact there? That's the capital reserve account. That's $90,000 going into ESG funds that are not already there. So again, just trying to paint a little picture here of what the capabilities that we have and the internal resources we have, because we have a full lineup of ESG funds, and we it's not Chris Lucas going out and doing his own research. It's the firm behind me, and we have a great roster of different funds and ETFs that we can bring to bear here.
Well, it sounds to me like, I'm going to let Alberto and Tom ask questions first.
None from me.
Yeah, it sounds to me like more discussion is needed about what we're really trying to do here before we make any changes to the policy.
And that was sort of where I think we have a better understanding of where we are at this
Yes.
point. And that'll help us carry on a discussion. If we want to leave things the way they are or clarify exactly what it is that we've done in our investment policy, et cetera, et cetera. But I think now we have a better grasp of what's going on, and that'll inform our discussion. So great, thanks.
Yeah.
Was there another one? Lisa, you got my email?
I do, let's see.
I've done 4 things. Was there a 5th?
So the only other one I think is individual equity holdings will primarily be concentrated in stocks from the S&P 500. The average dividend yield of the equity portfolio
yeah.
target the dividend yield of the
Good one.
S&P 500.
Good one.
So
Yeah, so that was that was actually, I had some sway on this because former trustee wanted to have that be a certain number or 1.5 times, and I said let's have it at least be the S&P 500, and the reason is, it sounds kind of okay, that's kind of an obvious statement, but what that means is we really can't have a growth tilt in the portfolio, because if we're having a growth tilt in the portfolio, that means our dividend yields will be below the S&P 500. And what the trustees at the time, and again, if you recall, this goes back to the equity income conversation, we moved into this in 22 here, and it was very much an unknown, high inflation, growth had just had a big run. What does the future hold? And obviously 22 was a tough year, and then ever since then, growth has taken off. But to put it in perspective, S&P 500 is around 1.1% yield right now. The equity income strategy is about 1.4, but if you factor in other asset classes, and let's go to page 11, and you go to the top of the page, and you'll see total equity in bold. Under current yield, you'll see we're at about 2.06 for the total equity yield. So we are absolutely above, and significantly above, the S&P 500. And a big reason is the strategies that we're employing. The equity income is going to have a higher yield, and also some of the international funds are going to have a higher yield as well. If you look at some of those are pretty high. So when you put it all together, there was an attempt there to kind of put in writing where the dividend yield should be. And again, it sounds wonky. I didn't want to box ourselves in one way or the other. I didn't want to have a marching order of a certain dividend yield but not be able to have growth names. That was my biggest concern, and that's why the language came out the way it did. But again, just to give you context for why that's in there and how it came about, and where we are right now.
Right. Okay, so with a question for further discussion here about whether that's an appropriate thing to have within our policy.
Investment policy.
And I will say, just to add sort of experience from other towns, that Durham is the only town that I have seen with a specific mandate for dividend yield in their investment policy, so.
To me, as you were all discussing with the broader group, it's much more important to have a clear marching order from a strategy perspective and benchmark perspective. We have this mismatching benchmark, utilizing the equity income versus the S&P 500. So obviously, getting that right is probably most important. And again, not to throw more at you, and I'm not advocating this at all, but we do have other, strategies that we can certainly speak to. I mentioned we have individual stock, ESG, a growth portfolio. Both of those are benched off the S&P 500. The equity income is the only one that's not, and we've discussed that at length. Have the different options, but it's the paramount that they all match up with the appropriate benchmarks for performance. You can evaluate us to make sure that we're doing everything is, aligned properly.
Thanks, Chris. I think the genesis of the question had to do with whether or not, given that language of the S&P 500, did that also require investment positions in just that pool of companies? Which I guess we weren't sure necessarily that everybody we've got listed under equity is in the S&P 500. They might be, I don't know.
Just about. There might be some mid and small cap. There's a few mid and small cap names, but
so there's a
90+%
classic example of, okay, here's the S&P 500 and they're doing this. And so I guess the genesis of I think I had the question, oh gee, does that mean we're limited just to the S&P 500 in order to match that dividend yield? So we're clearly not doing that through the small and mid cap, some of the small and mid cap stuff that we have. So it suggests that we ought to revisit that language in our policy anyway.
Yeah.
If nothing else, because of these other ideas, if we're trying to get some kind of growth in our principal, so that we're getting future income to negate the erosion of purchasing power by inflation, tying ourselves to the S&P dividend would probably work against, as I understand what you're saying, it works against us. Is that a fair assessment?
Potentially.
we just want to have latitude, and I don't. It's not really providing us with direction. And I was, again, going back to my comments to the trustees previously, it was more about don't restrict the portfolio to being so heavily value oriented, because again, they wanted that to be 1.5 times or whatever the number. Then I'm going to worry about, okay, if I'm adding to Apple, am I going to be too far, my name, am I going to be, out of limits with yield? So it's one of those things that could have been restrictive. It wasn't, and there's a reason for it. Or does it need to be in there? From my perspective, no. you see you see what the yield is on the portfolio, the equity, the deficiencies on a quarterly basis. If there's ever a question about where we are relative to different indices, whether it's S&P, whether it's others, easy for us to answer. So I just didn't want us to be boxed in. That's the worst, to be boxed in when you want to be able to provide your best thinking, again, within reason. But we have benchmarks to govern us. We have our asset allocation to govern us on the top level. So, to me, my opinion is this is unnecessary to be included in the document.
Well, maybe Alberto and I will recall that in mathematical optimization, every constraint you put on decreases your optimal output.
Yeah.
So,
Yeah, absolutely.
something like that.
I like it.
All right, good. Wow, we covered a lot of ground. Why don't we shift, if there aren't any questions from Tom, or clearly we've got work to do here,
Yeah.
and I think this is very helpful, and thank you for taking the time to research this in terms that we can understand, and we'll move forward, but not blindly. We'll be reaching out occasionally to say, oh yeah, what did that actually mean? And
Absolutely.
perhaps replay this recording for our education. So why don't we shift to the what's happening in the world?
Boy, it's we're off with a bang here to start the year. So if we go back to page 1. And I'll be brief with these comments. We talked a lot about the idea. If we do a little, 2025 in a review, the best thing that we did as an investment firm was not panic in March, April, May. We kind of sat back, looked at the different outcomes. You recall what I'm referring to as Liberation Day tariffs. Markets were in free fall, and we did not build what we call the recession portfolio. We did not hunker down. We weren't selling stocks. We weren't selling, our growth names out of the portfolio. And when I say that, think of Microsoft, Broadcom, some of the big winners. We sat back and said, cooler heads will prevail. Long story short, that has rewarded us. We had a very good 2020 to what the market gave us, given that we are, that more value-oriented strategy. We had a very good year from a stock picking side of things. The biggest thing that hurt us on relative performance, if you're looking at a one-year number, we did not get up to our full weight for international quick enough. And, that was the other story from the first quarter of last year. International stocks really started to move the first time in a decade that you've really seen big outperformance relative to the S&P 500 from the rest of the world. A lot of that was due to the declining dollar, but there's a lot to be said for a market that has perpetually underperformed, and the Sell America trade to a certain degree. I think that gets a little overblown, but it was a recipe for that outperformance, and we were a little late to the party there. Fast forward towards the end of the year, the last quarter, the fourth quarter, you'll see performance is pretty good. Kept up with our fixed income benchmark, mostly equity gave back a little bit, but you'll see that we started to see a shift in the fourth quarter. Value started to outperform. And if you look at performance relative to a value index, we're a little bit below, but we're significantly above the growth index. And the reason is, in reminding you of how our equity income strategy is composed, we're not pure value. If we were pure value, we wouldn't have some of these tech names that we do, but we don't have all the tech names. We don't have NVIDIA, etc. But what is encouraging about what happened in the fourth quarter is you're starting to see a little bit of a broadening of the market. And it's almost as if the market is, we're calling it the Benjamin Button economy or market, right? We're kind of going back in time here from a market cycle perspective. You're seeing certain sectors like financials starting to outperform. Financials outperform when it's early cycle in the economy. We think fourth quarter growth will be pretty good. We think it would be even better if we didn't have a 43-day government shutdown, but it still looks like it's going to be a nice quarter and some a little bit of a tailwind heading into the first quarter of this year. And then if you look at the, and I'll get to the negatives here in a minute, but if you're just purely looking at economics, in a good fourth quarter, you're kind of rolling over on the impact of the tariffs to a certain degree. Inflation has not been as bad as expected, and you have a massive bazooka of stimulus heading our way in the first half of the year, with tax refunds slated to be about $200 to $250 billion in excess of last year's refunds. And a lot of that money is going to be spent pretty quickly because a lot of people are hurting, especially the bottom 50% of wage earners. So there's a lot of stimulus. Rates are lower than they were a year ago, a lot for housing, but rates are a positive relative to recent memory. And the labor market has cooled. If I was, graduating from college or a couple of years out of school, it's a tough job environment, but we haven't seen the wheels fall off, and that's the key there. We absolutely, especially with white collar workers, I think a little bit of that is AI. Large employers are holding on to their work for the mid and small. You look at the numbers there, especially small businesses under 50 employees really hurting. I think they haven't been able to handle tariffs and inflation as much, and so they've been much more cautious. But with that being said, things are looking pretty good. Now, what is our forecast? What do we think for 2026? We think stocks will do well. We think bonds, probably coupons, so 4 or 5% return. We're not going to see that extra appreciation from interest rates falling like we did last year. So that 7% return, you're only going to get there with that appreciation. We don't see that as much this year. Probably rates will stay around the same level, but there's going to be a heck of a lot of volatility. Why? First, historically speaking, we're in a midterm election year. We typically see bigger swings during those years. Right now, one-party rule, more or less. I mean, the House is so close, it's tough these days to call it an outright majority, but that could be changing in November. More gridlock, which the market likes to see in DC. But kind of coming into that election, we'll most likely see heightened volatility, things over the weekend, potential government shutdown. All these things just lead to a little bit more instability, a little bit more, questioning what's going on. Geopolitics. Would it surprise me in the next few weeks? We have a pretty big strike in Iran. No. So geopolitics, something we're focused on. What's going on in Israel, what's going on in Ukraine, Russia, China. There's a tremendous amount going on. We haven't even talked about Venezuela, Cuba, the John Roe Doctrine. So again, just a lot of different things that could kind of pop at any time to kind of rattle markets. But what really, I'm saving this for last year, what really I think is going to drive markets here, and we think this has the makings of really helping, but it also could cause more anxiety, is the Fed. We have Chairman Powell. His chairmanship ends in May, and we should probably get an announcement within the next month, if not sooner, on President Trump's choice of the next Fed chair. And they're going to have a really difficult job, because they're going to have him chirping in their ear to cut interest rates, right? And we're sitting back. I already said a lot of positive things. I want to see, someone come in and cut. We want them to be making independent, data-based decisions. And could we see 1 to 2, cuts this year? Sure. More than that, that's tough right now. Again, labor market is hanging in there. You have some wind at your back. You've got stimulus. I think we really need to see a lot more weakness before we start talking about additional to that 1 to 2 level. So they're going to have to walk a fine line here with coming into a pretty tough job. And then the other thing I'll mention is the dollar. The dollar is going to be very important, just like it was last year. A big piece of the returns that we saw in international holdings was due to the dollar weakness. The dollar has already weakened to start the year. And, you know, I talked about geopolitics. Look what happened over the past, 10 days going into the World Economic Forum, Greenland, just on my way down to Connecticut for meetings last week. I talked to a nervous client on the way, and I said, listen, Joe, the U.S. just came out and said that we will not take Greenland by force. And then I kind of paused and I said, I didn't see myself saying that, I don't know, ever.
Was that on anyone's bingo card? No.
Yeah, like, holy smokes. And it just shows you kind of the wild nature of things, what we're dealing with, what we're kind of focused on, but then you kind of say, okay, well, what's going on over here? With that being said, you've seen this massive rush to gold, other hard assets, so you have seen the dollar sell off a little bit. A lot of clients ask me, near term, will things be okay? Yes. Longer term, is the damage, reverse certain, relations and the U.S. being that stalwart that it has been known for, that's to be decided. And so, that's something that's a longer term outlook. But I'll tell you, we're having conversations, and I'll wrap things up here. We're having good conversations on our asset allocation committee, and we're looking hard at potentially adding even more to international because things look a little bit more attractive, and if the dollar continues to weaken a little bit, which we think it might, and it's not necessarily not part of the administration to weaken the dollar to a certain degree to make our exports look more attractive, etc. That means that asset class could outperform again this year. We're currently at neutral, but that would mean we go to a slight overweight relative to domestic. And I always say that, like everyone remembers, what neutral is 80% domestic U.S. equities, 20% international. So if you were to go to an overweight international equity weighting, we're talking about 22.5, possibly as high as 25% of the equity pie. So not a huge move and not a huge percentage, but just to give you kind of a context for what we're discussing. But that's kind of a year in review, kind of our outlook here, and lastly, if we continue to see broadening in the U.S. market outside of tech and high growth names, financials, different areas of the market that haven't participated as much, that is 2 thumbs up. Very positive for another solid year. An asterisk of expect volatility, and volatility, if the trend continues, should be seen as a good entry point or a buying opportunity for cash on the sidelines. So that's our narrative to start the year, and we'll see how it goes.
Yeah, they are going to change the Fed chair. The last time I checked, the Fed chair only gets 1 vote on the Open Market Committee. So we'll see.
Yep, 100%. Yeah, it's gonna be fascinating. These are not normal times. We've seen more splintering at the Fed. Typically, we've seen when the Fed chair comes out, everyone lines up behind them. That has not been the case last few meetings. So again, I would not be envious of whoever gets this job, whether it's Rick Reeder, whether it's Kevin Warsh or Hassett, who seems to be in decline. I think it's between Warsh and Rick Reeder. They got a big job ahead. Big job. It affects us all. It's a very important job.
Yeah, indeed. Questions, comments?
Well, just a comment. Last year, Chris, first quarter, the same uncertainty. I remember you telling me this, because that's, and all those other decisions by the administration. And then second, third quarters, you told us that despite a lot of, I guess, threat of tariffs, the market somehow were able to figure out, and sort of make an educated or reasoned guess of what the economy will be like. Do you expect something like that this year also, that despite this early uncertainty, that by the second quarter, third quarter, there'll be, I guess, parity?
Yeah, but I think you're spot on, and I don't use this term a lot, but it keeps getting thrown out there. I'm sure you've seen it. Taco Trump always chickens out, and I will be specific that this is much more on the trade and tariff related items. Militarily, when he has talked about going in, they've gone in. That's why the Iran situation. I mean, the assets that they're moving to the region right now. That's the real deal. So I'll talk about exactly what you're speaking of. And Trump always thinking, okay, well, Liberation Day comes, and then 3 days later we go down to 10% tariffs. Greenland comes, a World Economic Forum, big talk in the morning, in the afternoon there's a deal, right? In a framework that no one knows anything about. And markets sold off. Gold hit an all-time high. Dollar weakening. These were all things that are, no one has any idea what they were trying to play. And then if you're me and I'm the investment manager, I'm sitting back and I'm saying, I know the players here. Rubio and Vance wouldn't allow this to happen. I know who's trying. You got Stephen Miller and one other who were saying go into Greenland for real. You're like, unbelievable. You have the Republicans in the Senate and in the House are coming and going, this isn't going to happen. I don't know why we're talking about this. Should they have been a little bit more vocal than they were? Absolutely. But at the end of the day, and I talked about this, buying opportunities. That day the Dow was down 900 points. I'm in there buying. Why? Because it's clear as day that this is up to a T, and it's amazing that Wall Street is having these types of reactions. And I think they'll get less and less because this continues to happen. It's rhetoric. Okay, we're going to settle here. And it's kind of, his negotiating style, I guess. Where I will caveat, though, is on the Fed chair and what the Fed does. And if we can't maintain the same level of Fed independence, because that is paramount to our economy. And we do not want to get into a situation where the Fed chair, the collective Fed committee starts cutting rates irresponsibly, because that will then lead to inflation. And that is and that is the bedrock of our economy. It's what gives international investors, the general public, institutional investors like myself, the confidence to go out and buy our debt, etc. So, it sounds like a small, okay, swapping Powell out, someone else coming in, that the Fed remains independent, that we continue to get decisions based upon facts and not, an administration's wishes for lower. Every administration wants to have lower interest rates, right? Because they want to get reelected. And everyone, when they go to buy a house, go to buy a car, wants to see rates lower, not higher. This administration and this president is taking this to, the nth degree, which is typical, of their style. But for the good of the economy, good for the country, we need them to remain independent. And that's why, I do expect to see some volatility around that. However, I do see these periods of instability as opportunities to buy, as long as we stay within those kind of same guardrails. Even back in April, we kind of sat back and said, if they pull back in a couple of weeks, we're okay. If this goes on 2 months, the economy's in real trouble. So as long as it's within certain parameters, but back, the economy is doing, pretty well. We have a lot of investment, whether it's military infrastructure, AI, power generation, and then into the banks and other areas, the markets start to perk up. That is a very, very good sign.
Thank you.
Don, anything?
As usual, a tremendous tour of what's going on, and obviously more questions than answers. So, but I appreciate it.
Absolutely. So I want to just focus. I'll just run through the capital reserve real quick here. You can see on page 3. Excuse me. December 31st, you can see top left-hand side, ending the year at just over 4.7 million. Right at about 40% in equity, about 52% in fixed income. Cash was elevated We did raise cash for some distributions that went out. That's why you're seeing cash a little bit elevated than usual. And then, let's go look at the bottom right-hand side. That tells the full picture. Okay, what happened? Of course, the year, starting the year at 3.8 million, ending at 4.7. You see three different lines: net contributions and withdrawals. So obviously there was money added to the account minus our management fee. So the net number was 438,000 coming in. But the investment piece is income earned. So that's dividends from the stocks, interest for 1,000, and then market appreciation primarily from the stock exposure of 308,000. So all-in figure for the portfolio of 10.3% for 2025. Great number. Obviously, we'll look at benchmarks and how we did. All right, kind of spoken to a little bit, but if you take a step back and you look at, what do we expect for typical returns for asset classes? So S&P 500 has been returning about 10% or so for the past 40 years on an annual basis. Let's say bonds are returning about 5%. Well, if you look at your portfolio, you're only 40% in the stocks, so that's 4% right there if you're getting 10% in the S&P. And then fixed income, 52. So where I'm going with this is, typically this type of portfolio should be returning 5 to 6% on an annual basis. So I think we've done a good job here, but also the market had a great year and we took full advantage of that. And so 10.3% return on a conservative portfolio in stocks is a very good year. So another positive year for the town and for the account. On page 4, you can see what I was referring to earlier. On the left-hand side, domestic equities about 80%. And then you can see the two international buckets, developed international just under 14, and emerging markets at about 6%. On the right-hand side, all this is showing is in the green and purple, the predominantly invested in individual bonds, government treasuries, 48%, and corporates about 44%. We do about 8%. We did have 8% in a intermediate gov credit fund that has been reduced with the cash moving out, but that's how we ended the year. And then the most important page, I'll start with here. So for the quarter, we came at 1.5 versus about 1.7, left a few basis points on the table. Another good quarter for bonds. We're up about 1.13 versus about 1.2. Equities came in about 2.29 versus 2.53, so left a few basis points on the table, but this is what I was referring to. If you go down that column, next line down, EFI, that's developed international, up almost 5% in the quarter, great quarter. Emerging markets, 4.8, great quarter. So international outperformed the US, that's a good thing, we have exposure there. Russell 1000 value, up 3.8, great, value starting to actually outperform. 1.92 for the dividend achievers, okay? That's more value-based, but it does have the growth names. We've talked about that before. Go all the way down, 1.12. Russell 1000 growth, 1.12%. That, we've rarely seen quarters over the past several years, and not until, going back to 22, where the growth has underperformed. If we continue to see this, that would not be a bad thing. Again, broadening out of the market, we would absolutely like to see that. If you look at it on a 1-year basis, stay in equities, we came in about versus the benchmark of about 18. Biggest miss that we had was not having that international exposure at full weight to start the year. If you look at below there, you'll see what I'm talking about. EFI came in at almost 32%. That's mostly Europe and Japan. Emerging markets, over 34%. Emerging markets had a huge year in 2025. Russell 1000 value, up 15.91. Dividend achievers, 14.5. And the Russell growth still outperforming value for the broader year, 18.5%. So where I'm going with this is I think the equity income strategy is well positioned for this broadening trade if it continues, and you should continue to see outperformance relative to the S&P that we haven't seen for quite some time. with that broadening trade. So I think it's, to be. Any questions? Plus, I don't have a voice.
We know the struggle is real. We appreciate it.
Absolutely.
It's cold season.
Absolutely.
Exactly. Okay. And maybe to save your voice a little bit, the town trust funds are essentially invested the same way as the capital reserves.
Correct.
There's not any real difference there.
Yeah, so you should see very similar returns. Obviously, distributions coming out have an impact on the top line. Money coming into and out of are always going to have a difference there. But the important thing to look for is the underlying returns in the fixed income and equity being the same, or similar. And that, if you look at both accounts there, we're pretty much spot on for equities, a few basis points off on the fixed income, but it's that a bit of a lower duration because the individual bond holdings are slightly different. So on page 18, you'll see what I was referring to there, having more duration, more interest rate exposure in 2025 helped portfolios. In the capital reserve, it was about 4.17 to end the year. The trust funds about 3.98, so right in the ballpark of where we want to be, but about a little less than a quarter of a year difference, made a little bit of a difference from a performance perspective. And the last piece that I wanted to on the cap reserve or trust funds was to go to page 29 of the cemetery account. And this is something we talked about last meeting. If you recall from that conversation, the cemetery has lagged performance to the equity income strategy that we're running. Obviously, we don't have enough dollars to implement individual stock selection, but performance was unacceptable from a standpoint of the delta kept widening, and a big piece kind of goes back to the inception coming here from People's. There was a desire to have a Schwab value fund, very deep value fund that I offset with an S&P 500 index fund. That worked initially, but the fund itself kept getting a little bit more towards value. Long story short, in an attempt to kind of right size this and get the performance delta to a minimum on a quarterly basis and bring them in line with what we're trying to achieve, more or less, because we are running our own strategy here. If you look at domestic funds, the second line down, Invesco, exchange traded, dividend achievers, ETF. So I sold out of the Schwab value fund and the S&P 5 index fund, and now we're fully invested in the ETF PFM for our the predominance of the domestic exposure in the cemetery account. So that happened mid-quarter. So going forward, you should see similar returns there. Because if you go back to page 28, you can see we returned about 9.4, which is good, but it should be higher given their equity exposure here. Fixed income, very similar to the trust funds, about 6.7, but equity was only up 13.25 for the year. So we want to see that delta. I'd like to see no delta between the strategies. There'll always be a little bit, but that's too much. So we made that call. We talked about it last time, and we implemented it during the quarter.
I would also say again that pooling this fund with the other common trust funds is certainly something that can be done. So then it would be wrapped into the other, and there would be no delta. So,
As I recall, yeah, I think at some point there was some idea of slightly higher equity, yes, idea within the cemetery fund, just because it's so small, we were trying to make it grow a little faster. It doesn't seem to be what it's done just yet, or at least this year. It's grown, but the number was a little lower than us.
yeah.
Correct.
But we can think about whether we want to dump it back in. But it's a relatively small amount. It's like less than $60,000. Money's money, but
Well, it might be something to think about too. The needs of the cemetery are a little bit different than the needs of the rest of the town. And, you know, we don't have large projects on a regular basis out there, so. You know, I know we were moving for more of a growth-oriented strategy, so maybe that's something for us to think about.
That's, Tom, I think that's a great point. We currently have the IPS set up so that, the NASDAQ dividend achievers is the, benchmark for all three accounts. You can kind of make a caveat. Hey, for the cemetery, use S&P. We want to grow, and I'll just swap PFM for S&P 500 index fund, and then we'll have that allocation, and that will be, pretty simple. So again, just something to consider.
Yeah.
It is a small amount. If you do want to keep it separate, certainly we can do something a little bit different there, and that's super easy for me to do. My big thing was trying to make sure that, when we're showing performance, we have great things going over here, and the cemetery's lagging. I want to at least close the gap. But if we want to change things a little bit to high growth, certainly moving to the S&P 500, you lose some of the defensive qualities for sure, but easy to do. So something to think about.
Appreciate that. Thank you.
indeed. Yeah, I did a little quick math. We have just over 6 million under management.
Yeah, it's terrific.
Good on us.
Great year.
Good for the town.
That's right, good for the town, absolutely.
Yeah, and to the extent that we raise money here, that's a few more pennies off the mill rate for the
There we
real
go.
estate taxes. We
right.
try to make our contribution.
Do you have any sense of what's coming up at the town meeting? Are there any warrant articles that we should be aware of? Any
The town
inflows,
looks a little
outflows?
differently.
Yeah.
So, no real to the budget.
Okay,
But I think big capital things still have to go to a vote.
Yeah.
But I don't remember what the threshold is.
right.
Yeah, we're an SB2 town, so, we don't have that element of surprise that you can get at town meeting.
Right.
And I'm not aware of any big expenditures coming out this year
Okay.
for the town.
Right,
The school district is talking about some expenditures, but that doesn't affect us,
okay.
except kind of as our British friends might say, the knock-on effect. The spending money on the schools might make it less likely that the town wants to spend money. The voters of the town want to spend money, let's put it that way.
Yeah. My tax bill still went up.
Yeah. It's inevitable.
Yep,
All right.
okay.
Any questions or Chris?
No?
Thank you again for
Yeah.
great presentation on how we've, as for delving into some of the nitty gritty
Yeah.
of the investment.
Very helpful.
policy. Very helpful.
Yeah.
Very
Thank you.
Excellent.
Any follow-ups, just let us know.
Yep, yeah. always
Happy
here.
to get back or jump on a call, whatever you guys need. We're here for you, and And thank you for letting me join virtually today. Really appreciate it.
Yeah.
Exactly.
Good luck with everything at home.
Yeah.
Thank you so much,
All
guys.
right.
Take care.
All right, everybody, thanks,
Right.
thanks again. Well, that concludes our non-meeting for today.
Meeting.
Again, thanks to our advisors at Cambridge Trust. Our next meeting is scheduled for Tuesday, February the 24th. And
Make sure I
it
have that
also
on the calendar.
means March 24th will be the meeting after that, because February and March line up,
Right.
except in leap year, which we're not in.
And I will put the third Tuesday of April on our
Yeah,
calendar. Or
Fourth Tuesday,
Yep,
so
yep.
whatever number that is will be our plans for the next quarterly presentation. Cambridge Trust,
Very good.
we look forward to
All
it.
right, excellent.
Thank you,
All
Lisa.
right,
Thank you all very much.
Thank
So, I'm gonna head to the town office and deliver a little something to
Oh, they'll
them.
be happy with
Oh,
that.
very
You all
nice.
should feel free to stop in and help yourselves as well,
All right,
Thank you.
so.
all right, Craig, I guess we're done.
Okay.
Thank you.
Thanks.